Hey guys, welcome back to my YouTube channel today. And we're going to be going over, is it possible to raise venture capital in this down market? So guys, here's a little bit of context behind this, right? We've gone through a lot since COVID-19, since the down economy, booms of technology like AI, startup valuations going crazy, and all this other stuff. So let's just kind of bring it back down into earth. I'm just going to make a brief video about what's been going on between this down market and other factors like federal interest rate cuts that are coming in the future and what could be the consequences of those, both good and bad. So, just for a little bit of data, just for you to kind of digest what's going on, a total of 1,200 venture capital backed startups have gone down over the past year. And on top of that, valuations have gone down. You have an anomaly of raising at down rounds, meaning that you'll be raising money at a lower valuation from which you started, right? But guys, this isn't all a bad thing. And have you ever read the mathematical equation, a positive times a negative equals a positive? Well, I solely believe that this could be the case, and here's why. I call this market correction, right? Because we all know in 2021 and stuff, there is a lot of companies being overvalued and they soon to collapse later. One of the most popular examples is WeWork, that was valued at a lot. They took on a lot of money and now they're bankrupt because, well, the overvaluation was over optimism that their system could have lasted forever. And that's just one case. In many cases, you've had this on the grand scale, you've had this on the lower scale. But with all these startups going down, now you have venture capitalists being more realistic with their valuations, with their evaluation processes. So data going forward is telling us that we're going to be having a more fair and a more correct fundraising cycle. Now guys, moving on to the other part here, right? If you guys haven't been living under a rock, you know that federal interest rates are looking to be cut 5 to 6 times in the later months, March, April. Now, what are federal interest rates? Well, it was a mechanism to combat against inflation. It is measured in basis points or bips. This is shot sky high because of the economy being basically shut down for a certain period of time with COVID, and just we haven't bounced back from what that's looked like from the global scale. So, what are the consequences of these federal interest rates going down? Well, we're going to have a more favorable stock market. And from the startup side, which I solely want to focus on that part, there's a lot of good that can become of this, right? So one, it's startups can have a lot easier time getting non-dilutive financing like your loans and your grants at a lot more favorable terms and a whole lot of less interest. But let's go on to the mechanics of the startup in the first place. So from a consumer insights side, startups are going to have a lot more revenue coming in for one of two reasons. One is going to be customers by default of this should have a lot more disposable income in order to go shop these startups type of products. Also from the startup side, right, they're going to have increased revenue, which that's always good, right, because cash is king. But for ones that are looking to raise, the good part about this is that this is going to create a favorable equity valuation. So a lot of the major valuation techniques that are look at a startup is going to depend on its revenue or its projected revenue, and in combination with things like EBITDA and all these other things. So I personally believe that this could be a good thing. So my ultimate thesis for this down market is that it's going to only increase in 2024. Now, we've learned from the past that having over optimism and overvaluation of startups, and we even saw it a little bit in quarter one of 2023 with the artificial intelligence, now is going to keep valuations more modest, and now all the bad actors before are now going to be out of the game, and there's going to be a lot more of the ecosystem correction and, most importantly, ecosystem best practices. Now we're going to be seeing trends like smaller funds just sticking to smaller rounds, down rounds being less current, and most importantly, we're going to be looking at a new fundraising environment where when the next emerging technology comes, we don't necessarily hop on the board just to go overvalue those startups in the first place. But also, one more thing that I kind of want to raise is that now founders are going to be more inclined, based on more disposable revenue and all these other things, to see if they actually want to raise venture capital, or if they want to bootstrap. So guys, this is my thesis on raising capital in the down market. If you like this, please subscribe, and yeah, weekly venture capital content and startups always coming.